For today's webinar, we will be discussing on the company results for the companies under our coverage that have announced their results last week. First will be Ascendas. First will be Ascendas REIT. So we initiated coverage on Ascendas 2 weeks ago, and we are maintaining our accumulate rating. Target price also same, 286. Forecasted DPU 15.8 cents. That will give you a 5.8% yield on the last close price from last Friday. Gross revenue was up 2.7%. This was due to a combination of their acquisitions done as well as the divestments of certain properties in the China portfolio, and as well as the decommissioning of one of the properties in Singapore for the AEI. Something to note here, distributable income for the year, for the current year is 11% higher compared to last year. That was due to a one-off adjustment in this year of 5.9 million, so that lifted the distributable income. In terms of DPU wise, is 4.3% year on year. There was a larger unit base this year compared to last year due to the conversion of the exchangeable collateralized securities during FY17. So first bullet point here, I've talked about it already. Acquisition was actually driving the higher gross revenue, and this acquisition will keep DPU sustainable for this year. Main driver for the higher revenue was this Science Park property, DNVDSO, that's in Singapore. The property was acquired in the fourth quarter of FY17, and it is the third largest portfolio is the third largest property in the portfolio, and it contributes 3.5% of gross revenue. The A-REIT portfolio has been resilient, and occupancy has improved quarter on quarter for both the Singapore portfolio and Australia portfolio. In terms of revisions wise, rental reversion for the entire portfolio was positive 1.7%. Individually, it's 1.1 for Singapore and 3.5 for Australia. So for Singapore, although there was a overall 1.1% positive reversion, but there was some negative reversions within the Singapore portfolio, and these came from the high specs industrial, light industrial, and logistics properties. Outlook for FY18 is stable. There are no leases expiring in the Australia portfolio in this FY, and for the Singapore side, there's 13.3% of leases by gross rental income that's expiring this year, and you should expect some negative reversions. However, these negative reversions will actually be offset by the acquisitions that were done that I've talked about in the earlier part. Again, also mention the difference between last year and this year is that last year there was the exchangeable collateralized securities that were being progressively converted during the year, and that led to a larger unit base during the year. However, this year there will not be any more further unit dilution, as that exchangeable collateralized security has already been fully converted. Lastly, the REIT has a healthy gearing of 34%. Next, Mapletree Industrial Trust. We have upgraded it from neutral to accumulate, a higher target price as well to 198. DPU forecast is for 11.4 cents, and that will give you a 5.9% yield over the last close price on Friday. So gross revenue was higher, 5.6% year-on-year. This came from the contribution after the completion of the phase 1 of the Hewlett-Packard build-to-suit project. So I've mentioned before, this build-to-suit project is a large project, and it will actually contribute 10% of the portfolio income when the whole property is completed. So we move on to the bullet points here. So I've talked about this organic growth. So we had a full quarter contribution from this phase 1 of the property. Fourth quarter FY17, there was a partial contribution because it was completed during the quarter, but this quarter is a full quarter contribution. And phase 2 of the project, which is actually a identical block, has received its TOP in the late part of June, so it will start contributing from 2Q18 onwards. For the portfolio-wise, in the quarter there was a negative 2.0% rental reversion. This came from high-tech buildings and business park segments. So for high-tech buildings, this was from renewals done at the Toa Payoh North 1 cluster, and the negative reversion from business park came mainly from a larger tenant renewing its space. That was quite a fair amount of space, 80,000 square feet. So they were given some discount in their renewal. The outlook for Mapletree Industrial is stable for this year. There's contribution from the completion of the HP build-to-suit project that will help to grow the DPU. At the same time, the gearing is low, 29.8%, and this will give the REIT the firepower to acquire. Looking a bit further out, they have some pipeline of projects coming in calendar year 2018. That's the first is the completion of their ongoing AEI at the Kallang area. That's 38 Kallang Place and Kallang Basin 4 cluster. So the AEI is to redevelop the property into a high specs building, and this will be estimated to be completed in the first quarter of 2018. At the present moment, there's no committed leases yet, except for a childcare center, which takes up about 3% of the NLA. So the manager will have to carry on with his marketing activities in order to lease out the rest of the properties. For build-to-suit, they also have a data center. It should be completing in the second half of 2018. Next, we have SIA Engineering. We downgraded it from neutral to reduce. Target price was unchanged, 370. You will notice that the current market price is already lower than the target price. We are forecasting dividend of 13 cents. That will give you a 3.6% yield based on last Friday's close price. Revenue was flat. Now going down to EBIT level, the reported EBIT, you see there's a large change from a loss of 1.6 last year to a profit of 18.1. But note that for last year there was a one-off provision of 21.3 million. So if you reverse that, the underlying recurring EBIT is actually 8.1% lower year-on-year here. For associates and JVs, marginally higher, 1.9%. This was from higher associates offset by lower JVs. We'll talk a bit more about the EBIT, recurring EBIT. So as mentioned earlier, the recurring underlying EBIT is 8.1% lower year-on-year. That's mainly due to the 5.9% increase in staff costs. Staff cost is the largest cost component, and it took up about 47% of revenue. So the 5.9% increase outpaced the 0.4% increase in revenue. associates was higher, mainly from Eagle Services, which deals with the Pratt & Whitney 4000 engine. So they are getting higher work content for Eagle Services and this engine because the aircraft operators have delayed the retiring of the older fleet because of the lower fuel prices. So going forward, this higher contribution from associates will eventually taper off as the engine progressively gets taken off the market. Outlook for SIA Engineering remains challenging. So we've mentioned many times already, there's a structural issue of lower work content. This arising from the improvement in technology and design that has led to better airframe and engine reliability. Also, going forward, we think that there will be scope for our forecasts for earnings and dividends to be cut if work content does not pick up in the remaining quarters. Now we'll move on to Guangzhi.
Hi, it's Guangzhi here. So the next is China Aviation Oil. They announced the 2Q results on last Thursday. So we maintain our buy call with unchanged target price of $2 and last time price was $1.65. Now let's take a look at the results. The revenue went up by 56% in the first half of this year. So to break down this growth, actually around 15% was from the growth of in trading volumes, and around 12% was from middle distillate, mainly jet fuel, and another 20% was from trading volumes of other oil products. So that means 30% of the growth was from the ASP, as we knew that in the first half of this year, crude oil, say Brent, went up by 20% compared with the same period in last year. So we need to, and also as the management say that they will enhance the trading efficiency. So in this quarter, the gross profit went up by around 13%. So we use the gross profit per million ton to measure this trading efficiency. Actually, in the second quarter, the gross profit per million ton was arriving at $1.26 per million ton, slightly improved compared to second quarter of last year. So we need to pay attention to the share profits from associates and joint ventures, since this component is the bottom line driver. So in the first half, the share profits slightly dropped. This was due to the FX translations. You can see here the US dollars appreciated around 4.6% against RMB in this period. So if we exclude the FX translation losses, actually the share profits from this part was slightly positive or flattish. So people may ask whether the growth of these share profits from associates can sustain or not. We think that we are still positive on the outlook of the contributions from this part, since the fifth runway in Shanghai Pudong International Airport will commence operation by this year end. So as of 2016, the passenger traffic in Shanghai Pudong International Airport was reported at around 60 million. So by 2019, it is estimated that the passenger traffic will reach 80 million. That means another 33% growth of the passenger traffic in Shanghai Pudong. So the growth of this passenger traffic will translate more air traffic, which can drive up the contribution from Pudong as well. So we are still positive on the outlook of China Aviation Oil. The next is Sembcorp Marine. They announced their results on last Thursday as well. So we downgrade our rating from neutral to reduce with a slight lower target price of $1.55 compared to previous $1.58, and the last time price was $1.70. So you can see the revenue, gross profit, operating profit, as well as net profit dropped by double digits, especially the net profit decreased by around 35%. So the main reason was that there is no replenishment to the order book. That means, as you can see here, so in the first half of this year, Sembcorp Marine only secured like 75 million worth of new contracts compared to last full year's $320 million. So to maintain the business, the management started to implement the expenditures cut. So in terms of OPEX, they will freeze the wage across the board of all employees, and they also will cut the 10% monthly variable component wage for the senior management staff. Then in terms of CAPEX, it is expected that another 50 over million outflows for the existing projects on the yacht, excluding the maintenance expenditure. So you can see here for the first 2 quarters this year, the capex was reported at around $100 million compared with last year's 190. So moving forward, we expect that the second half of this year, the capex won't be so substantial. So as the management mentioned in first Q, that quite a few inquiries for floating LNG projects. However, this quarter they say that this project the progress for in clinching the orders for these nearshore LNG solutions is quite slow. So for the outlook, we think that the Sembcorp Marine's weak performance will continue into second half of this year. So next will be Jeremy to talk about finance sectors.
Morning. Here's the SGX earnings. Okay, so what happened is the securities clearing securities side of the business has been flat. Although the first half volumes have picked up because of stronger investor sentiment. The average clearing fee actually is down from 1.9 basis points from FY16 to 2.82 basis points in FY17. So net is a flat top line for the securities. And the second is a 7% drop in the derivatives business. That is because the first quarter of FY16 has been particularly strong and has uplifted the overall FY16 revenue as compared to FY17, owing to the lower volatility. Generally, the year has been low for derivatives. The only pickup was towards the fourth quarter, as we can see here. It's up 82.1 million, up 10% year on year and 9% quarter on quarter on a quarterly basis. So most of the volumes drop came from the equities derivative side. So that is mainly the China A50 and the Nikkei 225. So the impact from China, the A50 would be, if you recall, 1.5 years back, there was some regulatory intervention from the Chinese onshore market, where they intervened into the market. So that kind of affected the CSI 300 volumes. The initial impression was that when they came in hard on the onshore, market participants might actually shift their attention into the China A50, which is actually the offshore equities futures. Unfortunately, 1.5 years later today, that volume didn't pick up. So the general sentiment is that as long as the onshore activity is low, the offshore market would also see a similar decline in activity. So the other segment includes the listing revenue and the market data and connectivity. Those have performed well on a full year basis, and we expect that to actually have to have a steady growth moving forward. And the just to highlight, the securities average fees decline because of increased trading of warrants and ETFs, and these products carry a lower yield, a lower clearing fee. So we estimate that the volume of warrants and ETFs as a percentage of the total securities volume is about 2% in 2016 and has increased to 5% in 2017. And here's the chart just to show you visually how the volumes and the yields for the two products, the equities and commodities derivatives and securities. So as you can see here that the total derivatives have increased over the years, but we see a marked decline here in FY17, while the yield per contract has roughly stabilized. As for the securities clearing business, the traded volume has maintained. Unfortunately, the average clearing fee has come down, and this average clearing fee could have a downward pressure as if we expect the volumes of warrants and ETFs to as a percentage of total volume to pick up. So next we have the OCBC results. OCBC has recorded a broad-based growth for their net interest and non-interest income. So this has been, the net interest income has been boosted by an expansion in the loans volume year on year. Net interest margins were down because of unfavorable rates year on year, but it is supported by some of the higher yields from the interbank loans. So that gave some tailwind to the net interest income growth. And the second part is the loan to deposit ratio for OCBC has gone up to about 85%. Previously is 82-83%. So if we our report on in January, sector report in January has argued this point of moving the LDR higher to increase the net interest income growth. So we are seeing that playing out for OCBC, and the management has guided more flexibility to push the loan to deposit ratio higher from the current 85. So we could possibly estimate it to move a bit higher to 86% in the second half of this year. And one of the positive factors to increase yields on their loans for OCBC would be the higher spreads on their customer loans, on their customer overseas expansion loans. So they will charge a higher spread on this overseas expansion as compared to local projects. Finally, what might weigh down moving forward in the second half is that some of the higher sensitivity to competition, because as of now, slightly more than half of OCBC's loans are pegged to board rates, which are influenced by competitive forces. And board rates would, for example, would be the fixed deposit pegged loan rates. So in that aspect, if competition were to pick up, we could see the margins compress a little bit. Or I would say, the margins from those board rates might compress a little bit. The NPLs are stable at 1.3%, but the coverage ratio remains low at 100%. And this would mean that if the, especially in the offshore oil and gas space, where although now the situation is stable, but if any unforeseen downward volatility were to kick in, OCBC might have to respond immediately to that, and it could create some volatility to its provision expense. The last point is a strong insurance and wealth management franchise. So as long as if the general market is trending, the sentiment on the general market is strong and volatility is well contained, we will continue to expect a strong performance from Great Eastern Holdings investment portfolio, as it has performed quite well in the second quarter. And as for OCBC, it has already, as Bank of Singapore, it has already completed the acquisition of the Barclays Wealth Management, and the AUM has grew as 2/3 of the AUM came. The growth of the AUM came from the net new money. And finally, we have results for UOB. UOB's net interest income growth came mainly from the higher loans growth and also from the higher yielding interbank loans. So the stronger loans growth could be attributed to the overall positive economic sentiments, and the higher yielding interbank loans were as a result of some of their Chinese clients, Chinese banks, which they were able to place some of these interbank loans to. And we expect the UOB's loans to shift away from SOR and SIBOR pegged rates to adopt the broad rates, quite similar to OCBC. This is on the back of the fact that the SOR rates are quite volatile, and the SIBOR rates have not moved up meaningfully as the Fed as Fed's were as the Fed rate is moving up higher. So the broad rates, as much as it gives pricing flexibility, but again it's susceptible to competitive forces. So how does it really impact the UOB in the sense that UOB has a big significant weight of Singapore property housing loans on its balance sheet. So the Singapore property housing loans is a competitive market. So if the competition is to pick up, as we have alluded earlier this year in our sector report, then there could be some pressures on the loans that's pegged to the board rates. The NPL outlook is stable at 1.5%, and the coverage ratio is adequate at 113%. So we do not expect the provision expense to be volatile. We expect it to be quite stable. But therefore, given the UOB's guidance for 32 basis points of total credit costs for full year, we will estimate the provision expense for full year will be 730 million as compared to FY16's 594 million. And the higher provision expense, you can say, is to build the coverage ratio higher beyond 113%. As for geographical footprint, we are seeing that UOB is becoming more active in Thailand, Myanmar, and Vietnam. Thailand has been a strong base for UOB, so the Myanmar and Vietnam will be newer markets, and Vietnam is the latest addition where they have got the in-principle approval for a foreign subsidiary in there. So this footprint in this region, we believe gives them opportunities to capture the One Belt One Road opportunities initiatives. So this is something which we can look forward to. It's not a near-term benefit, but it's a longer-term project for them. However, they remain weak in Indonesia, despite the fact that Indonesia is the largest economy in Southeast Asia. As we recently, there's OCBC has reported the Indonesian results, as well as Maybank has reported Indonesian results. And when we compare UOB's results versus these two, we find that they're still lagging behind by quite a large margin. So in that sense, I think that for UOB, there's still a lot of room to catch up if they wish to gain traction in Indonesia. Okay, that's the end of our presentation. Please write your questions into the question box and we'll answer them. Thank you.
Hi, it's Guangzi here. There is a question asking about why sales share price dropped over the last few trading days. We think that the drop started since the results announcement. So we think that because the previous increase in price was due to the market expectation of the growth in CAO. However, this quarter, as we stated before, the share profits from associates was disappointed. So the market may price these sort of unfavorable factors into the current price. But we are still positive on the outlook of CAO since the fifth run rate as the catalyst will be realized by this year end, as well as the satellite terminal will be commenced operation in 2019. So the business will stay at positive growth.
Hi. There's a question on the mid long term. How do we see Sheng Siong in business performance? You're referring to mid long term. Linson is not here, but from what I understand from her views, obviously with the onslaught of Amazon, it's going to be very problematic. They are already offering free with a purchase of $40, I believe there's a delivery within 2 hours. So obviously, Amazon is going to be very destructive for the whole retail scene, not only for Sheng Siong. Without by just launching immediately, they can already offer you cheap prices. I think it's similar or even cheaper than Red Mart, and also and with only a 2-hour delivery. So the other issue for Sheng Siong, the way to respond is they are focused on non-groceries and also to open up more stores. But again, it's going to be structurally, it's going to be very problematic, as we know how destructive Amazon can be once they land in Singapore. And sorry, just to follow up, and I think Lindsay also mentioned that she believes that there would likely be some price war with Amazon coming in at present. Thank you. Okay, there's another question on Sheng Siong, which is what is your view of Sheng Siong? We see the share price dropping. I think we've seen some brokers downgrade Sheng Siong following Amazon. I think as you can read from Lin Sin's presentation and her report, I think she says that there is still some growth for Sheng Siong in the near term as they open up new stores and they focus more on the fresh products. But the other point is that Sheng Siong did cut their dividends, if you notice on the slide. So that could be another reason, apart from the Amazon, that we see this price drop in Sheng Siong.
There is a question asking about the view on city environment tech. So we don't have any coverage on this counter, so we wouldn't have any comment on this. Thanks. So the questions about what price to accumulate CO at, we think that for the fundamental of CO's business, we are bullish in the long-term view. So we think that it hasn't hit our target price. So we think that the current price still is sorry about that. So we think that the current price is okay to enter, since CEO will pay the have a constant dividend policy.
Hi guys, thanks for tuning in today. If there's no further questions, we will end our presentation here. If there are any more queries, just please feel free to email the respective analysts. Thank you.